Howdy, Jacob here. Today we're looking at Beacon Roofing Supply in the trading companies and distributors industry. 6.2 billion market cap and 8.7 billion enterprise value. So we are looking at a bit of net debt here. Company founded in 1928, headquartered in Virginia. It's been around for quite a while. They engage in the distribution of residential and non-residential roofing materials and complementary building products to contractors, home builders, etc. Return on invested capital recently pretty solid, 9-10%, but historically probably in the 5% range. But you are looking at an increase of gross and operating margin from about 10 years ago. So that's pretty solid. Revenue growth has actually been very impressive. So for how long they've been around, since 1928, I mean, this is absolutely crazy growth. I know some housing stuff went a little crazy from COVID, but even before that, you were seeing some pretty big growth here. So I want to see in 2016, 2018, let me see if those were just big acquisitions. 2016, 2018, big acquisitions. What do you know? So a lot of the times you're able to create the story while you're just looking at these financial statements. But so we are seeing big growth from acquisitions there, and they actually did improve on the margin side. So that's a positive sign, meaning that they were likely advantageous acquisitions, I guess. And then on the balance sheet, we're seeing just 84 million cash on hand, 10 million short-term debt, 2.2 billion long-term debt. That 2.2 billion long-term debt in relation to their 5-year average free cash flow of, let's say, 300 is a lot. Seven times. Oof, that's a lot. So 7 years of their 5-year average free cash flow to pay off all of their long-term debt. Again, that's nothing is a black or white metric. There's always gray area in what's positive, what's negative. I mean, different types of industries have different types of debt level, but in essence, I really like under 3 years, because then they don't have to focus so much capital allocation on debt reduction. They can focus on the most advantageous things for you as the shareholder, like buying back shares when they're super cheap, making acquisitions that are incredibly advantageous, or reinvesting at double-digit rates of return. I mean, there's just so many better things to do than just debt reduction. But again, when you have a lot of debt and it's coming due, you do need to focus on debt reduction to get down to a ratio that makes the most sense to you. So this is where I'm going to have to balance out what I want the company to do with their capital allocation with what they've done historically. So let's start making some assumptions here. On the revenue growth side, I guess we can go over it a little bit here. The acquisitions is a little bit, share repurchases a little bit, and then just issuing a lot of debt. Gosh, I don't really like that. They bought back some preferred stock here. Okay, so yeah, I mean, we're not seeing a huge history of what they're doing with capital allocation. They have a dividend. They said that pays $13 million a year. I mean, that's nothing, so they can definitely afford that. It looks like it's just a random dividend. Maybe it's an annual dividend. Maybe they went away. But okay, so not really nothing there. So on the revenue growth side, let's say, I mean, with some very advantageous acquisitions, they'll probably be able to grow 4% a year. But again, I have to balance out what they've done historically, which was to go into a lot of debt to fund those types of acquisitions. Look at this. 2.7 billion was the net acquisition. They went into debt 1.9. 1 billion went into that 900 million. So they're just going into debt to fund these projects, and with what you get from free cash flow should be how you allocate your capital. Obviously, there's things that make sense to go into debt for, but I mean, you should have a good cash on hand. That's a healthy business would have a good cash on hand balance, and they just don't have it. They're down to under $100 million with over $2 billion in debt, long-term debt. So on the terminal P side, I'm actually going to change it because I want to create my terminal value based on enterprise value as much as I can, and I think that they'll be able to reduce debt by $100 million a year and be able to afford that. So for 7 years, you're looking at about $700 million. it's still going to be a pretty solid difference between your enterprise value and your market cap. So maybe I'll go even on the 11p in price free cash flow. For margins, maybe let's do 4 and 5. And then for share repurchases, they have repurchased a bit of shares recently. So 63 million. 63 million is 1%. And then to offset that, you're looking at about 90 million. And that would be pretty close to about a third of their free cash flow. So, yeah. So we're saying a third to share repurchases, a third to debt reduction, then a third to acquisitions and reinvestments. That makes sense. And then maybe $20 million to fund a dividend. That's going to be about a 0.1% yield. This is going to be nothing. But I guess it'd be more like 0.3. Doesn't matter. Anyways, with that capital allocation in mind, with these projections in mind, we're saying the company needs to fall 63%. Company's stock price needs to fall 63% before you get the return I'm looking for here. So again, we're looking at a company that looks fine. They've been around for quite a while, big growth. Whether they can achieve that growth in the future or not is dependent on their ability to make solid acquisitions, but they do have to start focusing on that debt, given the fact that it's about 7 times their 5-year average free cash flow. So I do hope you enjoy the video and have a great rest of your day.